Viewers at home, you are welcome to my presentation on shutdown decisions. In my previous presentation, I've examined relevant costing in decision making. In this presentation, I am going to examine the shutdown decisions. Shutdown decisions. If you have not subscribed in the past, or if this is your first time of coming across my channel, please hit the red subscribe button and turn on the notification bell icon so that you'll be receiving a notification message each time I drop a new video. If you are a returning subscriber, I say thank you and God bless you. Before I proceed to shutdown decisions, I want to recap my previous presentation on relevant costing. So I've defined relevant costing as the differential future cash flows that arise in direct consequences of decisions. The differential future cash flows that arise in direct consequence of decision. From that definition, the key word or key concepts are: number one, differential. Number two, future cost, that is future cash flows. Number three, cash flows. Number four, direct consequences of decision. Direct consequence of decision. Direct consequence of decision. So I said relevant cost are differential future cash flows that arise in direct consequence of decision. The word differential means changes. That is, all relevant costs are changes costs. They are costs that change. That is, they are incremental costs, not fixed. Even though some of them could be fixed, those fixed costs will relate directly to the decision. So they are changes cost. So number two concept is future cost. All relevant costs are future costs. They are future costs. Past costs are not relevant. Past costs are what we call sunk costs. Past costs are called sunk costs. Since the decision is about the future, all relevant costs must be futuristic in nature. Past costs are not relevant. The third word is cash flows. All relevant costs must be cash flows. Non-cash items are not relevant. Examples of non-cash items are depreciation, amortization, impairment, depreciation, amortization, impairment, profits or losses from the disposal of non-current assets. So all those ones are not relevant. So because they are not cash flows, relevant costs must be cash flows. Now, the number four is direct consequence of decision. Meaning that those costs that are specifically related to the decision are those costs that will be relevant to that decision. That means the purpose of incurring them or incurring those costs is as a result of the decision you are about to make. So that is direct consequences of decision. I want to break down the concepts. Of relevant costs into different divisions. Number one is directly attributable fixed cost. Directly attributable fixed cost. Concepts of relevant cost. Concepts. The first concept we are going to look at is directly attributable fixed cost. Directly attributable fixed costs. Directly attributable fixed costs can also be called specific fixed cost. They can also be called specific fixed cost. They are the fixed costs that are specifically incurred because of the project. They are the fixed costs that are specifically related to the project. They are incurred because of the project. These costs can be saved where the project is not to be undertaken. They can be saved where the project is not to be undertaken. Where the project is not to be carried out, the cost can be saved. That is, that cost cannot be incurred. If you don't want to incur that cost, that means you do away with the project. So if you do away with the project, such costs will not be incurred. That is why we call it directly attributable fixed cost. But in any attempt for you to carry out or to execute the project, such costs must be incurred. So that is directly attributable fixed cost. Number 2 concept I'm going to look at is opportunity cost. Opportunity cost. Opportunity cost is the value of the benefits. The value of the benefits sacrificed in expense of others. The value of the benefits sacrificed in expense of others. In economics, we used to say opportunity cost is the forgo alternative. That is the alternative forgone. So, meaning that before the concept of opportunity cost can be used, you must have more than one alternative. You must have more than one option. Maybe option A and option B to decide from or to choose from. Maybe you may have option A, B, and C to choose one that is the most favorable to you. So that is when to use the concept of opportunity cost. You can have the opportunity cost of materials. You can have the opportunity cost of labor and others. The value of benefits sacrificed in expense of others. Maybe you have been producing a product A, and this product A used to fetch you contribution of 10 naira. Let me say product A, it used to fetch you contribution of $10 per unit. You just discover product B, and this product B will fetch you contribution of 15 naira, $15 per unit. If you now choose to execute product B, maybe the materials needed for product A have to be diverted to product B. That means you cannot carry out both product A and B at the same time. If you want to carry out product B, if you want to execute project B, you have to stop A. If you stop A, the contribution of 10 naira you will forgo from A is the opportunity cost of producing product B. And that opportunity cost, it is contribution. Contribution is an inflows, but since it is an opportunity cost, you are treating it as opportunity cost of one product or project. So you are going to treat it as a cost of carrying out this project. So that contribution from A will be treated as opportunity cost of B. You want to forgo that contribution of $10 because you want to execute B. That means if you don't want to execute B, then you will still go ahead with A, and that A will fetch you contribution of $10 per unit. But in any attempt for you to go ahead to produce product B, then the contribution, if you divert the resources from A to B, then this contribution will not be earned from A. So it will be treated as opportunity cost of product or project B. So now I want to illustrate it. So I want to look at different concepts of opportunity cost. Number 1, where you are considering whether to sell an existing material or to use it in production. You want to consider between selling an existing materials or to use that existing material in production. If you want to decide from the two alternatives now, that means you either choose one, that is, you either choose to sell it or to use it in production. If you want to use it in production, then you will not be able to sell it. The opportunity cost of using it in production will be the amount you will realize from the sales of that material. But if you want to sell it, that means you will not be able to use it in production. The opportunity cost of selling it will be the cost of its usage in production. That is material. I've told you that you want to decide between selling an existing material or to use it in production. Opportunity cost of you using it in production. No, if you use it in production, you will not be able to sell it. So the amount you will realize from its sales will be the opportunity cost of its usage. That is for materials. Then another scenario where labor has to be diverted from another project that will lead to loss of contribution from that project and used to complete the project under consideration. I repeat, where labor has to be diverted, has to be diverted from another project that will lead to loss of contribution from that project. You want to divert labor from one project, maybe from project A. You want to divert labor from project A to B, and an attempt for you to divert that labor, it will lead to loss of contribution from project A. That will lead to loss of contribution from that project and used to complete the project under consideration, and now use it to complete project B. You know, you divert labor from A. If you divert labor from A, it will lead to loss of contribution from project A, and you now want to use it in project B. That is opportunity cost of that labor. Opportunity cost of using that labor is the loss of contribution from project A. That is another concept. Now, number 3. No, I've told you that I've given you two different scenarios. Scenario 1, that is opportunity cost, where I illustrated that. I said where you are considering whether to sell an existing material or to use it in production. I've told you that if you use it in production, you will not be able to sell it. The opportunity cost of the usage of that material is the amount forgo from selling it. Then the second scenario is that where you want to divert labor from another project that will lead to loss of contribution from that project and used to complete the project under consideration. If you divert labor from A to B, that will lead to loss of contribution from A. The opportunity cost of that labor, of you using that labor in B, is the loss of contribution from A. Now, the third scenario, I want you to illustrate the concept of opportunity cost is where you want to decide whether to use the existing equipment in the project or to dispose it off. You want to decide whether to use the existing equipment in the project or to dispose it off. If you use it now, you will not be able to sell it. You will not be able to dispose it off. The opportunity cost of using that equipment is the amount it will fetch you from disposing that equipment. So that is opportunity cost of equipment. That is where you want to decide whether to use the existing equipment in the project or to dispose it off. So that is opportunity cost. I want to look at various concepts. So I have tried to divide all the concepts into different divisions for better understanding. I want to look at the plant and machinery. Plant and machinery, or plant and equipment. Plant and equipment. This will be divided into two. We have existing plant and equipment, and the new one. The newly bought plant and equipment. The existing and the new. So the existing one, the one they already have. So I'm going to divide this into 3. Number 1, the cost price. cost price. Number 2, the net book value. Net book value. And the third one is realizable value. Realizable value. So I want to start with the cost price. Notice existing equipment have been bought sometime in the past. It have been bought in the past. The amount it was bought as at the time of purchase is known as the cost price. Cost price is the original purchase price. And being the original purchase price, since it have been bought sometime in the past, remember I've told you earlier that relevant costs are future costs. And I told you that the past costs are not relevant. Since it have been bought in the past, that amount it was bought is a sunk cost. The cost price is a sunk cost. Sunk cost. I told you that sunk cost means past cost. And I've told you that the past costs are not relevant. A sunk cost. The purchase price is a sunk cost since the machine will have been bought sometimes in the past. The purchase price is a sunk cost and it's not relevant. The second one is the net book value. Net book value is the combination of the purchase price. The combination of the purchase price, that is the value it was purchased, which was regarded as a sunk cost, and the depreciation, which is not a cash flows. The combination of the purchase price and the depreciation is the net book value. Therefore, the net book value is cost less accumulated depreciation, and even the accumulated impairment. That will give you the net book value. So, which is not a cash flow. Remember, depreciation is not a cash flow, so it is not relevant. So, the net book value is not also relevant because it is a combination of cost price, which is a sunk cost, and the accumulated depreciation, which is not also a cash flows, and the two concepts are not relevant. Therefore, the net book value of the existing plant and equipment is not relevant. The third one I'm going to look at is the realizable value. Realizable value. The word realize means to sell. It means to sell. By undertaking the project, we miss out the opportunity of selling the asset. If you undertake the project, you will not be able to sell the asset because you want to use the asset in that project. If you want to undertake the project, you will not be able to sell it. The word realize means to sell. Since that asset will be used in that project, you will lose the opportunity of selling the asset. The realizable value of the asset is the opportunity cost of undertaking the project. The realizable value is the opportunity cost of that asset in undertaking the project. Therefore, you are going to treat it as opportunity cost. Remember, I've told you earlier that opportunity cost is a relevant cost in decision. So it's relevant. So you are going to treat it as opportunity cost, which will be relevant for the decision. So that is for plant and equipment. The next one I'm going to look at is materials. Material. What are materials? Materials are the substances from which goods are manufactured. This material, just like plant and equipment, I'm equally going to categorize it into two. Sorry, let me explain. I categorized the plant and equipment earlier into existing and the new one. The new one is the amount you incur in purchasing a new one for the project. Meaning that the purpose of purchasing the new plant and equipment is for the usage in the project. The purchase price of that new plant and equipment is a relevant cost for the decision making. So now for materials now, we equally want to categorize that materials into two. Existing material, existing and the new. Existing and the new one. Let me call that new one bought in materials or new materials. These new ones, the bought in materials, are the materials specifically purchased for the project. That is the material specifically purchased for the project. The purchase price of the material is the relevant cost of that project. So, for the existing material, I'm going to categorize it into three, just like the plant and equipment I've considered. Now we have the cost price. Cost price, the amount it was bought. Cost price. We have realizable value. I've told you realize means sell, to sell. Realizable value. And the third one is replacement price. Replacement price. All these costs, all these concepts have been explained on my presentation on relevant costing. I'm just trying to recap. Please, if you want to have my full lectures or all the presentation by me, just search Ezikan Academy. Ezikan Academy on your YouTube app. Then you now click, it will take you to my YouTube page. Then click on my page icon. Then you now look at the top, you will see a playlist. Then click on that playlist. Then you will see different organized playlists. Then you click on the playlist of your choice. You see a number of videos, some are more than 30 and so on. So you click on the playlist of your choice. Then you will see all the videos on that particular course. Because you'll be seeing many presentations in my channel. So I am on cost price. Cost price means purchase price. The purchase price is have been bought in the past because it is in existence. The purchase price is a sunk cost. Purchase price of an existing material is a sunk cost. Sunk cost. Remember, I've told you that sunk costs are not relevant. So that is not relevant because it is a past cost. It is not relevant. Then realizable value. Realizable value. Realize means to sell. That means you want to decide between selling it or to use it. Now, where you are told that this material is no longer required, that is where it will not be replaced, then you can think of selling it. Then the lost scrap value or lost contribution is a relevant cost. Realizable value will be used where that material is no longer needed, where it is no longer required. It is then that you think of selling it off, then that will be used as relevant cost, where it can be ascertained from the question that that material is no longer required, or where it is no longer needed. They might use another phrase or clause to illustrate that, where you can see words, wordings or clauses or phrase in the question that that material is no longer required or no longer needed. Then you use the realizable value of that material. But where that material is regularly used, that means if it is used regularly, the moment the existing one is exhausted, then you have to buy another one. In that case, the replacement price will be the relevant cost where it is regularly used. Please always watch out the wordings from the question. After that, this cost price is not relevant, you use the realizable value where it is no longer needed or required. But where it is regularly used, you use the replacement price. Now, I want you to take note. Materials no longer required, or where it will no longer be replaced. I'm talking about realizable value. Use the opportunity cost. The opportunity cost of this material, realizable value, could be the lost scrap value or lost contribution. It could be the lost scrap value or lost contribution. That is for realizable value. Where material are in short supply, where the material are in short supply, the only way the proposal can be undertaken will be by foregoing another part of the segment of the organization. Where the materials are in short supply, that means you have to forego another segment, maybe another department or another product. Maybe product A, they used to produce product A, B, C, D. If the material is in short supply, you either forget A and produce B and C or D. So where the material can be, I've told you that you only forego another part of the segment of the organization where the material can be used, where the same material will be used. So you forgo that segment so that you'll be able to use it on the most profitable one. Relevant cost in this case, I mean where there is what? Where the materials are in short supply. So where the material are in short supply, the relevant cost will be normal cost of the material. Where it is short supply, where the materials are in short supply, the relevant cost will be normal cost, the normal cost. That is the, if you want to buy it, the amount it will cost you, the normal cost of that material, plus lost contribution in other department, plus lost contribution. Lost contribution in other departments. Remember, where you have to divert material from A, the contribution from that A will have to be lost. That's what I mean by lost contribution in other department. Or you want to divert material from B, the contribution in that B will be lost. So that is the contribution. Then you take the normal cost of that material plus the contribution that will be lost. I've told you that this will be considered as relevant cost where the materials are in short supply. Where the materials are in short supply. Then the next concept I'm going to look at is labor. I'm going to examine labor. All these concepts have been explained on my presentation on relevant costing. So labor, what is labor? A labor is a human effort used in production. This labor, I'm going to categorize it into two. We have the full-time workers and part-time workers. Full-time and part-time. Full-time. The full-time workers are called salaried workers. We also have part-time. While part-time will receive wages. The salary paid to full-time workers is not relevant. How will you know it is a full-time? It is a full-time where spare capacity exists. Where spare capacity exists. You know it is full-time. Why it is part-time where full capacity exists. Where full capacity exists, you know, it is part-time. The wages paid to a part-time workers, I said, is relevant. So this part-time, I'm going to categorize it into two. Where you can hire more labor and where you can't hire more labor. Where you can hire more labor and where more labor cannot be hired. Can hire more labor. Where you can hire more labor, and the other one is where you can't hire more labor. where you can hire more labor or take extra staff or pay overtime. The relevant cost is the extra cost of labor. Where you can hire more labor or where you can take extra staff or where you can pay overtime. The relevant cost is the extra cost of labor. The second one is where you can't hire more labor. Where you can't hire, that is where you cannot hire more labor. In this case, you can only divert labor from another department. That means you are going to apply opportunity cost. You can only divert labor from another department. That is where you can't hire more labor. In this case, relevant cost is the opportunity cost of diverting labor. Opportunity cost of diverting labor. You know, where you can't hire more labor, you can only divert labor from one department. So that means if you divert labor from the other department, then the contribution from that department will be lost. So the opportunity cost of diverting that labor will be the relevant cost of that labor. Then I want to look at general fixed overheads. General fixed overheads. General fixed overheads. Anytime you see general fixed overheads, apportionment, overheads apportionment, overhead apportionment, overheads absorption, overheads allocation, all these concepts, whenever you see any of these, that cost is not relevant. That cost is not relevant. So these are the concepts I want to look at, and therefore I want to take question as work example. And this question is from an ACCA past examination question. ACCA past examination question. So example from the past ACCA. So the question: example, Stay Clean manufactures and sells a small range of kitchen equipment. Specifically, the product range contains a dishwasher, WD, a washing machine, WM, and a tumble dryer, TD. The TD is of a rather old design and has for some time generated negative contribution. It is widely expected that 1 year's time the market for this design of TD will cease as people switch to a washing machine that can also dry. A washing machine that can also dry clothes after washing cycle has completed. Or not to cease the production of TD. You want to decide whether to or not to switch, not to cease the production of TD now or in 12 months time, when the new combined washing machine dryer will be ready. To help with this decision, the following information has been provided. You are given those information. 1. The normal selling prices, annual sales and total variable cost for the 3 products are as follows. You are given DW, WM and TD. Selling price per unit $200, $350, $80. Material cost per unit $70, $800 and $50. Labor cost per unit $50, $80 and $40. Contribution per unit $80, $170 and minus $10. Annual sales 5,000 units, 6,000 units and 1,200 units. It is thought that some of the customers that buy a TD also buy a DW and a WM. It is estimated that 5% of the sales of WM and DW will be lost if the TD ceases to be produced. 3. All the direct labor force currently working on the TD will be made redundant immediately. If TD is seized now, this would cost $6,000 in redundancy payments. If Stay Clean waited for 12 months, the existing labor force would be retained and retrained at a cost of $3,500 to enable them to produce the new washing/drying product. Recruitment. And training cost of labor in 12 months time will be $1,200 in the event that redundancy take place now. 4. Stay Clean operates a just-in-time JIT policy, and also all material costs will be saved on the TD for 12 months if TD production ceased now. Equally, the material costs relating to the lost sales on the WM and the DW would also be saved. However, the material supplier has a volume-based discount scheme in place as follows. You are given total annual expenditure in dollar, and then you are given discount. Between 0 to 600,000, 0% discount. Between 600 and 1,000, 600,001 to 800,000, that is 1% discount. Between 800,001 to 900,000, then you are given 2% discount. Between 900,001 to 960,000, you are given 3% discount. And between 960,000 and above, 5% discount. Stay Clean uses this supplier for all its materials, for all the products it manufactures. The figures given above in the cost per unit table for material cost per unit are net of any discount. Stay Clean already qualifies for. Number 5. The space in the factory currently used for TD will be sublet for 12 months on a short-term lease contract if production of TD stops now. The income from that contract will be $12,000. 6. The supervisor currently classed as an overhead supervises the production of all 3 products, spending approximately 20% of his time on the TD production. He will continue to be fully employed if TD ceases to be produced now required. Calculate whether or not it is worthwhile ceasing to produce the TD now rather than waiting 12 months. Ignore any adjustment to allow for the time value of money. That is the question. So that is the question. So now we want to answer the question. We want to decide whether to cease TD now or to wait till the end of 12 months period. That is what you want to decide. Let's have the solution. If you wait till the end of 12 months, remember the contribution that will be forgone from TD will be $10 per unit. $10 times 1,200. That means the contribution you will forgo will be $12,000. That is if you wait till the end of 12 months. But now, if you now decide to cease TD now, so what you need is the relevant cost of decision to cease manufacturing of TD now. That is what you are needed. So you have, if you want to cease manufacturing TD now, so what will be the relevant cost? So you compute the relevant cost. So let me have relevant cost stroke revenue. If you want to cease manufacturing TD now, so you compute the relevant cost of that decision. So now let's take it one after the other. Now, back to the question. The normal selling prices, annual sales, volumes, and total variable cost for the 3 products are as follows. If you cease manufacturing TD now, that means revenue from TD, the selling price per unit of TD is $80. That is the selling price. The total revenue from TD will be lost. To calculate the total revenue, because this revenue will only be earned if you continue till the end of 12 months. But if you seize it now, then $80 per unit revenue will be lost, and on the sales of 1,200 you expect from TD. So 1,200 times 80, that will give you the lost revenue. Lost revenue, if that is, if you cease manufacturing TD now, how much will be the revenue that will be lost? So we have lost revenue, which is 80 naira per unit multiplied by the number of units, which is 1,200 units. That is the amount of revenue that will be lost. So 80 times 1,200, and that will give us $96,000. So that is the amount of revenue that will be lost if you cease manufacturing TD now. But if you still continue with TD, you will still earn that revenue. So it is lost revenue. That is why I am treating that as an outflow, because it will be lost if you cease manufacturing TD now. So let's go through the adjustment. Let's go through the adjustment. The note 2. Note 2. What you have in note 2 is, it is thought that some of the customers that buy a TD also buy a DW and a WM. Some of the customers that buy TD also buy a DW and a WM. It is estimated that 5% of the sales of WM and WD will be lost if TD ceases to be produced. If you cease TD now, you are going to lose sales. 5% of sales of WD and 5% of sales of WM. That is if you decide to cease TD now. That is the opportunity cost of ceasing TD now, will be the lost contribution. If the sales is lost, 5% of the sales is lost, that means the contribution relating to that sales would also be lost. So lost contribution from other products. Now let's calculate the lost contribution from other products. 5% is what you are going to lose. 5% of the sales of WM and WD. That is what you are going to lose. Let's compute the lost contribution from other products. Lost, let me have working 1. Lost contribution from other products. Lost contribution from other products. The other products you are going to lose contribution are DW and WM. DW and WM. You are going to lose 5% of the sales. And the sales is, the sales of DW is 5,000, while the sales of WM is 6,000. We have 5,000 and 6,000. 5% of 6,000. The contribution we are going to lose now. Remember, contribution is sales less variable cost. Sales less variable cost. Ordinarily, our contribution will be selling price minus materials minus labor. But I'm going to exclude material. Ordinarily, contribution ought to be 80 naira per unit that will be lost. But I want to exclude material. The reason is that you are given a discount because you were told that Stay Clean operates a just-in-time policy, and also all material costs will be saved. That is note 4 on the TD for 12 months. ETD production ceased now. Equally, the material costs relating to the lost sales on the WM and DW will also be saved. However, the material suppliers has a volume-based discount scheme in place as follows. Because of those information about the discount which they are going to enjoy on that material, that is why I'm excluding materials from it. You know, if you have 200 minus 70, it will be 130. 130 minus 50, and that will be 80. That's how they got 80. We will have used 80, but I'm excluding material now because of the discount. So now I'm going to consider 200 minus 50, and that will be 150. So that is for DW. DW, that is 200 minus 50. That is 150. That is selling price minus labor cost per unit. That's what I am only considering. I've excluded the material cost per unit. I'm considering the selling price and labor cost. Then for WM, we have 350 minus 80. 350 minus 80. So, and that will give us so 200 minus 50 will give us 150. 150, you know, the lost contribution of DW will be 5% of 5,000. 5% of 5,000, that will give us 250. 250 times, you know, 200 minus 1, minus 50 will give us 150. 250 times 150, and that will give us $37,500. $37,500. That is for DW. Then WM, 5%. If you have 350 minus 80, and that will give us 270. Then if you have 5% of 6,000, 5% of 6,000 will give us 300. 300 times 270. Then we have 81,000. 81,000. If you have 81,000 plus 37,500, if you sum it up now, plus 37,500, then you have 118,500. 118,500. That is the contribution that will be lost from other products. Lost contribution from other products will be 118,500. So that will be considered as part of the relevant cost. So lost contribution from other products, you have lost contribution from other products, which is 118,500. 118,500. 118,500. That is note 2. Now let's go through the note 3. Note 3, we have all the direct labor force currently working on the TD will be made redundant immediately if TD is seized now. All the direct labor costs, all the direct labor force currently working on the TD will be made redundant immediately if TD is seized now. So, if you seize TD now, the normal labor cost you will have incurred on TD, what will happen to it? Will no longer be incurred. If you seize TD, the cost of labor of $40 per unit, which will have been incurred from now till the end of 12 months, will not be incurred. That means the normal labor cost will be saved, which is 40 times 1,200. So that is labor cost, and that will be saved. So we have the labor cost, saved labor cost, labor cost saved. You know, lost contribution from other product, that is working one. Saved labor cost will be, you are going to, the labor cost is $40 per unit times 1,200, and that will give us, since it is a savings is an inflow, that cost will be saved. So we have $48,000. That cost will not be incurred. 40 times 1,200, that will give us $48,000. Then save that same note 3. Let's read further. Same note 3. This will cost $6,000 in redundancy payments. $6,000 redundancy payment, that is irrelevant cost. So you are going to have that redundancy payment of $6,000 is relevant. If stay clean, because you are going to incur this because you want to cease the manufacturing of TD now. So that means it is specifically related to it is incur in direct consequence of that decision. So that will be a relevant cost for the decision. If stay clean waited for 12 months, the existing labor force will be retained. If they want to cease in 12 months time, they will still retain the labor, and then they will have to retrain them at a cost of $3,500. To enable them to produce the new washing / drying product. Now, the opportunity cost now of the production now, if you now want to continue, then that means you have to retrain the labor force with 3,500, and that is also a relevant cost. But if you cease TD now, because you want to consider seizing TD now, if you seize it now, that means this retrain cost of 3,500 will not be incurred. It will be incurred. The opportunity cost of seizing now, if you seize now, this cost now will not be incurred. Because if you seize now, then there will be no need of you producing TD again. I remember, if you want to produce TD, if you don't want to seize now, it is then that you will need to retrain the workers and incur 3,500. The opportunity cost of seizing now is the amount that will be saved. This amount will be saved if you seize now. So that is going to be treated as retaining costs that will be saved. So recruitment and retraining costs of labor in 12 months will be 1,200. Recruitment, in the event that redundancy take place now, if it take place now, you will incur 1,200 on recruitment. That means if you did not stop now, this will be saved. You are considering the opportunity cost of stopping now. If you stop now, then you will incur the retraining cost of 1,200. Remember the 6,000? 6,000 will be incurred. So, no, all the direct labor force currently working on the TD will be made redundant immediately. If TD is ceased now, this will cost this. If you cease now, then it is then that you will incur this. This is a cost. You are going to treat this as an outflow. That means if you did not cease now, then there will be no need of you incurring this $6,000. You will incur redundancy payment if you cease now. So you treat it as cost of ceasing now. If stay clean waited for 12 months, the existing labor force will be retained and retrained at a cost of 3,500 to enable them to produce. Now, remember our decision now, we want to decide whether to cease now. If you cease now, that means this cost of retraining will not be incurred. That means the cost will be saved if you cease now. So that will be treated as a saving cost. I've told you that the cost that will be saved will be treated as an inflows. Now, the other one too, the 1,200 will be 1,200 in the event that the redundancy take place now. If it take place now, you are going to incur 1,200. That means if you stop now, if you cease TD now, then you will incur the redundancy cost of 1,200. So that means this 1,200 will be treated as an outflows. So now let's have the redundancy and recruitment cost. Redundancy and recruitment cost. Let me have that as working tool. Redundancy, working tool. Redundancy and recruitment cost. You know, you were told all the direct labor force currently working on the TD will be made redundant immediately if TD is ceased now. This will cost 6,000 in redundancy payments. So this means the redundancy payment of 6,000 will be incurred. Redundancy payment of 6,000 will be incurred if you cease TD now. If you cease TD now, you will incur a redundancy payment of 6,000. That is a cost to you. An outflow on the decision of you ceasing TD now, you will incur that cost of 6,000. Then we also have if stay clean waited for 12 months, the existing labor force will be retained and retrained at a cost of 3,500 to enable them to produce the new washing or drying product. That means if stay clean waited for 12 months, if you now want to wait for 12 months, no, our decision now is to cease it now. If you cease now, that means there will be no need for you to wait for 12 months. That 3,500 cost of retraining will not be incurred. That means the cost will be saved. If you want to cease now, no need of retraining the workers to do the work again. So now, retraining cost saved now. Retraining cost saved. And that is 3,500. It is a saving cost, so we treat it as an inflows. Then we also have recruitment and training cost of labor in 12 months' time will be 1,200 in the event that redundancy takes place now. If the redundancy takes place now, then you will need to incur the recruitment cost of 1,200. So recruitment cost. Recruitment cost of 1,200. This is a cost because it's a cost that will be incurred if you cease TD now. Now we have minus 6,000 plus 3,500 minus 1,200. Then we have minus 3,700. That is redundancy and recruitment cost of 3,700. So that is a relevant cost of that decision. So we have redundancy and recruitment cost. Redundancy, and recruitment. Cost. That is working to 3,700. 3,700. 3,700. That is the redundancy and recruitment cost. So, then let's go through note 4. Note 4. Stay clean or praise. A just-in-time policy. And so, all material costs will be set on TD for 12 months. If TD production ceased now, if you cease producing TD now, the materials cost will be saved on TD for 12 months. If TD production ceased now, equally, the material costs relating to the lost sales on the WM and the DW would also be saved. However, the materials suppliers has a volume-based discount scheme in place as follows. Remember when we were calculating our contribution the other time, I purposely excluded the materials from the calculation of contribution because of the discounts given, because of all these discounts. So I now want to consider the materials. The materials now, that is, we want to consider the materials. We have working 3, that is supplier's payment. Supplier payments. We have DW. We have WM. We have TD. We have the net cost. We have discount, and then we have the gross cost. Now, how much is the current cost of that material? Current cost. Remember, the materials, the cost for W and DW, the material cost is 17 naira per unit. 17 naira per unit on 5,000 units. So I will have 70 times 5,000. And that will give us 350,000. 350,000. others will be calculated the same way. For WM, we have materials, which is $100 times 6,000. That will be $600,000. $600,000. 600,000. For TD, we have $50 times 1,200, and that will give us 60,000. $60,000. 60,000. Now let's sum it up. 350,000 plus 600,000, that will be 950,000. 950,000 plus 60,000, that will be 1,010,000. 1,010,000, and that will be the materials you have to purchase for all the products. 1,010,000. Remember, you will enjoy certain discount, and you are given different discount. If the 1,010,000 is between 960,000 and 1 and above, that means you enjoy 5% discount. That is, if you want to produce the 3 products, you enjoy 5% discount because for purchasing 1,010,000. So 5% discount. And remember, you have been told that this materials is net of discount. You have been told the discount so yes, you were told the figure given in the cost per unit for the materials. You were told Stakely uses this supplier for all its materials for all its materials for all the products it manufactures. The figures given above in the cost per unit table for material cost per unit are net of any discount. The figure are net of any discount. Stakely already qualifies for a net of any discount. That means, since that figure is net of discount, that means the discount Stakely qualifies for a 5%. That means the 5% will have been deducted from this. This is equivalent of 95%. So, if this is equivalent to 95%, then you will need to calculate the gross cost. To compute the gross cost, you may calculate 5%, the discount. 5%. It's not 5 over 100 because this is equivalent to 95%. So that means you have 5 over 95 times 1,010,000. If you calculate 5 times 1,010,000 divided by 95, then the discount is 53,158. That means that is the discount. When you now add 53,158 to 1,010,000, that means the gross cost will be 1,063,000. 63,000 and 158. If you add that discount, the discount is calculated just. Discount, what I've done is 5 over 95 times the gross cost, which is 1,010,000 times 1,010,000. Because that discount has been deducted, this amount is net. Discount of 5% have been deducted. This will now be equivalent to 95%. percent. So that is why I use over 95. So the discount gives me 53,158. You now add 53,158 to 1,010,000. Then you now have 1,063,158. Alternatively, you may have gross amount or gross cost equals to, you want to calculate 100%. That will be 100 over 95 times 1,010,000. And that will give you 1,063,158 directly. So that is the current cost you incur. You incur this, then you enjoy 5% discount, then you are paying this. Then, since you want to stop TD, you were told remember you want to stop TD. It is thought that some of the customers that buy TD also buy DW and WM. It is estimated that 5% of the sales of WM and DW will be lost if TD ceases to be produced. Yes. And you were also told that stay clean operates a just-in-time in JIT policy, and also all material costs will be saved on TD for 12 months if TD production ceased now. If TD production ceased now, all material costs would be saved on the TD if TD production ceased now. So that means the cost you incur on material for TD would be saved if you decide to cease the production of TD. So that how much is the cost that will be saved? The cost on TD is 60,000. So loss of TD or cost of TD that will be saved, that is 60,000. 60,000. So that goes out of the cost. 60,000. So the net cost 60,000. You are reducing that cost by 60,000 because it will be saved. That means this material, if you cease TD now, you will not buy up to this. Loss of sales, loss. You were told that you are going to lose 10%. It is thought that is note 2. Some of the customers that buy a TD also buy a WM and a DW. It is estimated that 5% of the sales of WM and DW will be lost if TD ceases now. Isn't they will lose 5%? That means they will not have to buy up to this again. Then 5% of DW, 5% of 5,000. 5% of 5,000, the materials that will be lost. 5% of 5,000, please take note of how I calculate it. 5% of this 5,000 will be lost. That will give us 250. 250 times 70. That means 17,500 will be lost on DW. 17,500. So now let me put loss of related sales. So this question is obtained from ACCA Practice and Revision Kit by Kaplan. K-Plan Practice and Revision Kit. So, DW now. The sales of DW that will be lost. 5% of this giving us 250. 250 times the material that will be lost, which is 70. That will give us 17,500. So loss of related sales we have that will be lost is 17,500. That of WM, 5% that will be lost. 5% of 60 of 600 of 6. 5% of 6,000. Then we have 300. 300 times the material cost of 100. That will give us 30,000. So 300. Then you have 30,000 that will be lost. 30,000. The total will be 70. If you add this 17,500 plus 30,000, then you have 47,500. That will also be lost. Ordinarily, you will not need to buy materials again. Remember, you will not need to buy up to these materials because of those lost. Now 5% is lost. No, you have lose 5% discount as a result of reducing your materials. 5% discount is what you are going to lose in respect of those materials. Now you gross it. Let her calculate the gross amount that will be lost. The gross amount that will be lost, just the same way we've calculated the first one. Gross amount that will be lost for this on this 60,000. The gross on the 60,000. Gross cost, which is 100 over 95 times 60,000. 60,000 times 100 divided by 95. Then we have 63,158. 63,158. 63,158. That's what we are losing on that. Then for the second one, then 47,500. 100 over 95 times 47,500. 100 times 47,500 divided by 95. Then we have 50,000. 50,000. So now you are losing 50,000 on this. So now the net amount now will be, if you subtract 1,063,158, 1,063,158 minus 63,158 minus 50,000, then you have 950,000. For this will be 950,000. That is the material you have to buy. If you want to cease TD now, you will not need to buy materials that is up to this again. So what you will buy will be this. Then that means the discount you will enjoy. Now let's look at, since it is based on volume based, you are going to enjoy discount based on the volume you purchase. If you want to cease TD now and buy materials of 950,000, how much will be the discount you will enjoy? So you have the discount 950,000. 950,000 is between 900,000 and 960,000. That means the discount you are going to enjoy now will be 3%. It will be 3%. So that is the amount of discount you will enjoy on purchasing 950,000. So instead of 5% discount, you will only enjoy 3% discount. 3% discount. Your discount has been reduced now if you cease TD. If you reduce your discount 3% by 3%, the net cost now, if you calculate 3% of 950,000, 3% of 950,000 your discount will be, the discount now, 3% of 950,000. I'm not using 3/97 because I'm calculating it on gross amount, which is equivalent to 100%. So 3% of that. So we have 3%, the discount you are going to enjoy, 3%, which is 28,500 now. So the net cost now, net cost will be 950,000 minus the discount of 28,500. The net cost is, if you subtract that, the net cost will be 921,500. 921,500. That is the net cost here. 921,500. Now, you are paying, that is net, that is the new buying cost now. New buying cost is this. If that is the new cost now, then what now happen? You supposed to pay 1,010,000. That is when you continue with TD. But as a result of discontinuing with that TD, if you stop TD now, your cost reduces. That means certain amount of cost will be saved. How much will be saved now if TD is stopped? Supplier payment saved. Payment saved. If TD is stopped. You know, if you continue with TD, you have to pay 1,010,000. That is what you ought to have paid. But if you are by stopping TD now, you are paying 921,500. How much has been saved? The amount saved now. What is the difference? It's 88,500. That is the amount saved if TD is stopped now. So I've told you that saving cost will be treated as an inflows. Supplier payment saved. Now, supplier payment saved. That is working 3, which is 88,500. 88,500. Then let's go back to, let's look at note 5. Note 5. Note 5. You were told the space in the factory currently used for TD will be sublet for 12 months on the short-term lease contract. If production of TD stops now, if you stop TD now, you are going to do what? You are going to sublet the space you use for TD for 12 months. The income from that contract will be 12,000. That is the opportunity cost of stopping the TD now. If you stop the TD now, it is then that you'll be able to sublet the space. But if you decide to continue with the TD, that means you won't be able to sublet the space. The opportunity cost of you stopping TD now is the income you will earn from that space, and that will be treated as a relevant cost. So sublet income, and that is $12,000. That is from note additional information 5 to the question. Note 5 of the question. Then note 6 now. The supervisor currently classed as an overhead supervises the production of the 3 products, spending approximately 20% of his time on TD production. He will continue to be fully employed if TD ceases to be produced now. That means that supervisor will still be continuing. That means a full-time staff. And that means the salary you pay to him will be a fixed cost. Even though you cease TD now, he will continue to be fully employed if TD ceases to be produced now. That means that cost will still be incurred. The amount you pay to that supervisor will still be incurred even if you decide to cease TD now. So that will, the relevant cost of that supervisor is nil. I've told you that where you have a full-time workers, that those people receive salary, that the salary you pay to them. So I said it is not relevant. Supervisor salary is not relevant. So that is all about that. You cast this. The first thing is minus 96,000 plus 118,500. Minus 118,500 plus 48,000 minus 3,700 plus 88,500 plus 12,000. That will give us 69,700 negative. 69,700 negative. That is net cash flows. Net cash flows. If you cease TD now, the relevant cost of you ceasing TD now is 69,700. But if you now wait till the end of 12 months before you cease TD, you will lose contribution of $10 per unit. $10 times 1,200, and that will be 12,000 naira. So now what will be your decision? If you cease TD now, you will lose more. 69,700 will be lost against 12,000 that will be lost if you cease TD 12 months time. That means it is not viable. It is not financially worthwhile to cease TD now. So your advice will be to cease TD in 12 months time. It is not worthwhile. It is not worthwhile to cease TD now. So what I mean is that it is better to cease TD in 12 months time. It is better to cease TD in 12 months time. So that is all about shut down or shut down a segment. Please, if you have not subscribed previously, don't forget to click on the red subscribe button and turn on the notification bell icon so that you'll be able to receive a notification message each time I drop a new video. Thanks. Be expecting more from me from time to time. Thanks.